Hi everyone, and today we'll be discussing flexible funds in a little bit more detail. But I think before we start discussing flexible funds, and particularly these flexible funds that we're discussing, the 361, the Truffle Flexible and the Batelier Flexible Fund, I think it's important just to firstly look at the category that these funds sit in. So what I've got up here is the current asset allocation of this particular category. Again, it's the multi-asset, the CISA SA multi-asset flexible category. And one can see that it's not specifically for you to look at a particular fund, but what I want to illustrate here is just how diverse the funds are in this particular category. So here in this category, you'll find funds that are essentially equity funds. You find funds that are 85% property. You've got funds that's sitting with 75% cash exposure. And you also have a fund that's essentially 100% invested in SA fixed income. And that's your SA cash and your SA bonds. Now, so looking at this particular category, it can be quite challenging for you, the advisor, to know exactly which fund to choose and which fund to use in your clients' portfolios, and really to get a sense of what you can expect both from a risk and a return point of view. So, but that's luckily where we come in at INN8 Invest. We spend a lot of time doing due diligences, not only on the investment side, but also on the operational side. And we essentially want to answer two very important questions. Firstly, from an investment point of view, does this manager that we're looking at have skill or not? And then also from an operations point of view, is this company operationally sound? And that's also very important. So with that in-depth analysis that we do, we can understand exactly what to expect from a particular fund and really how to use that strategy in a portfolio to achieve a specific desired outcome. So, hi everyone and the gents, and thank you for joining us today. And I want to begin this session with a question that I think a lot of people want clarity on. And that is, if you look at all three fund names, right? So you've got 361 Flexible Opportunity, Truffle Flexible, Batelier Flexible. What does that flexible mean? How do you define flexible, and are you really flexible? And Sai, let's start with you.
Thank you very much. Good morning, or about good afternoon, everyone. Look, I think for us, and I'm sure for the other two people on stage, we're definitely smaller businesses. So I'm just been said here, even in the last talk, we're obviously much smaller, therefore more nimble, more flexible. You're able to move around, not only in equities, but obviously in different asset classes. And the whole idea of a flexible fund, I guess, is to try and understand, where your best returns are going to be. Are they in cash? Are they in equities? Are they in bonds? Offshore equities, offshore bonds, and is to effectively have the correct mix of that. So we change our mix dramatically. I mean, had we come into COVID, for example, had you followed us, and our equities were down to, I think, 15%. And there are times where we're up to 60, 70%. So for us, it's very much a changing mix based on the opportunity set we see at the time. And I think we're able to do that because we're small, but because that mandate is flexible, we really like to stretch it as far as possible. And we even stretch it more than our balance funds, which are obviously Reg 28 compliant and have got a little bit less restriction. But overall, that's as much as we can. I mean, obviously you can't go short like a hedge fund, but you can pretty much do everything else.
Right. Side?
Can everyone hear me? There we go. So I think, echoing what Sai said, I think the first thing is, given the flexibility of the mandate, means that you can put your best foot forward in terms of your asset mix. There we go with load shedding. We've got to be flexible and adaptable. So just stay with me. But no, I mean, I suppose one is looking to achieve, CPR plus returns that our clients are after. And I mean, we've sort of managed to do, CPR over plus 7% over time. And I think we've also done it by managing the downside. And I think the flexibility helps you with that. Is, often many clients are looking for a solution where you can get your real return that you're looking for, but in the same breath, there's, almost guarantee or not, soft protect your sort of capital values. And I think that flexible or the flexibility of the mandate allows you to do that. And I think when you're going into an environment where those tail risks look as though those probabilities are rising, like Si said, you can aggressively de-risk your fund. So you don't just sit with some strategic holding and try and extract, some sort of risk premium, whether it be from equity or whether it be from bonds. And one's invited to really look at those underlying pieces. And then on top of that, I would add, from a currency point of view as well. There's lots of opportunity because the rand, everyone in the room knows, probably one of the most volatile currencies in the world. Trade $15 billion a day. I mean, it's massive EM currency, and it tends to display lots of volatility. And when you've got money offshore, when the rand blows out, you're invited to reflect and say, should we bring money back? And in the last 12 months, we've been as high as 42 offshore, and we've been as low as 23. So giving you a sense, in terms of taking advantage of that. So it's less strategic, like let's say a high equity Reg 28 fund, and very much focused on protecting downside while still delivering those CPI plus returns over time.
Great, thanks, Ian. And Warren, just from your side, what does that flexibility mean to you?
Yeah, I think very simply it's allocating capital or being able to allocate capital to the best investment opportunities with the least amount of constraint. So if you look at when we started our flexible fund in 2010, it was in response to looking at we started as a hedge fund manager in 2005, and looking for a retail product that could offer very similar type of structure to the hedge fund space and the type of return attributes we like to generate, but obviously more applicable in the retail space. So over time, we've run that fund our flexible fund as a cash and equity type fund. So on average, we've had 80% in equities. We've got an objective of delivering returns of inflation plus 4%. So the best place to generate that type of returns is equities over time, and that's been the case. But if you look at the fund over the time period of 13 years, we've had 10% to 40% cash. We've had 0 to the current 13% in bonds, being a mix of South African and offshore bonds, and offshore equities from 10% to the kind of 34-ish where we are today. So there's been a lot of movement amongst the asset class, and the ultimate aim is to generate a return which looks like equity but at a lower risk.
Yeah.
I think that's kind of the best summary of it.
Perfect. And I just want to maybe pause on that particular point that you made, but before I get to that, this particular category, as a lot of the panelists have also said, you're completely flexible in terms of your asset class exposure, with the only real limit being that 45% offshore. So, and you've mentioned, historically the Battalier Flexible Fund has been more of a cash equity play. In the second half of 2020, you included SA bonds in the portfolio for the first time ever. And in June this year, you included a small allocation to offshore bonds. And I think that is actually, I think that was like a 2% allocation. That's actually increased to about 4% now currently. So my question to you, Warren, is just, are these moves more opportunistic, or are you deliberately trying to be more multi-asset? Or what I mean by that is more diversified from an asset allocation point of view?
I think every investment decision we look at, we're basing this on where can we find the best risk-adjusted return to kind of meet our objectives. So historically, I'll talk to SA bonds. If you looked at the differential between money market and South African bonds, to take on that duration risk, we never thought we were compensated enough to take on that risk. During COVID, repo rate was slashed dramatically, and whereas bond yields stayed relatively high, money market rates came low. So there was a nice big gap we could take advantage of there. So I think that was more tactical in picking up the yield differential. And I think then speaking to the allocation to global bonds more recently, again, you've had 12 years almost of QE and financial repression in the world where rates were kept at almost zero. bonds were a very dangerous place to be invested. And I'll give an extreme example. If you look at, I think it was Austria who issued in 2020 a 100-year bond at the time at 0.8% yield. With the move in global yields higher, that bond has lost 70% of its capital value. You're going to have to hold it for 100 years to get all your money back, but you're not going to be around for that. So, I mean, I think what you've seen today is that in global bonds, yields have moved higher, inflation's come down, and you're starting to get real yields again, which start to actually make sense from a capital allocation perspective. So we've started moving some of our dollar cash into short-term 2-year treasuries in the US. We haven't got brave enough yet to start picking up duration further out, talking 10 to 30 years, where we think there's still risk that yields can still go higher and you lose capital.
Okay.
So very much concentrated on the short end.
Thanks. Then, Sai, a question for you. We know that your approach, very style agnostic, moving between value and growth wherever you see the opportunities, and it's also a combination of your fundamental bottom-up analysis with, or combined with a top-down macro overlay. Why do you think incorporating that top-down macro overlay is important?
Look, you need to understand the world. So you need to understand what's happening in the world, where interest rates are, where you are in the cycle, because I think that's going to very much determine, whether equities are over or undervalued, whether bonds are a good opportunity. And that cycle is significantly important in our view in generating alpha in all your products. So it's not as simple as just bottom-up fundamental. We've seen over time you can be a deep value manager looking at cheap equities on 3-4 multiples and get stuck there for 15 years. So for us, we very much don't want to silo ourselves in any one of those categories. And we need to understand where the world's at, and we have to have a view on where markets are at. And with that view, we're going to build bottom-up and choose the best sectors. We're going to choose the best asset mix.
Yeah.
And hopefully, that's very important. I don't see how you do one without the other.
Yeah. And Warren, then from your side, you also explicitly state that your approach also combines that bottom-up and that top-down overlay. So I assume you agree with a lot of the points that Sai made.
Yeah, I mean, again, probably to the point, our prices were pushed down by QE and global central banks' involvement. Asset prices as well were boosted by that. So if you didn't have a strong view of what central banks were thinking and doing in terms of interest rates and where inflation was going, it was very hard to make a call on equities. So one had to start incorporating it specifically from 2009 post the GFC, much more of a macro overlay. But I think it's not just a top-down view. Macro also feeds into a lot of the bottom-up fundamental stock picking we do, especially when you think about a resources stock, trying to understand the commodity cycle, and again, down even to some of the work we've done on the beer industry. So trying to understand demographics in each country and what the beer drinking age is going to do over the next few years, because the IMF has data which shows you the cohort, which is kind of your 18 to 21-year-olds, what that's going to look like over time. Yeah. That should give you a sense of how the beer drinking population should emerge over time. So we incorporated it everywhere, and not just in kind of the top-down view.
Great. And then, Sai, just a question for you and Warren, and specifically for you guys, just because you obviously have been managing hedge funds for a number of years. You're quite strong in that field. When it comes to these flexible funds, does that hedge fund mindset come through in the management of these long-only strategies? And if so, exactly how does that happen? So let's start with you.
So for us, the hedge funds actually sit alongside the flexible and the balanced funds. We actually a benchmark agnostic house in total. So bearing in mind, these are not market benchmark funds. So you're not trying to, if BTR is 5%, you don't have to have a view on BTR or not. You're just trying to make an absolute return that's going to beat inflation or cash or whatever your benchmark is. So for us, it's the exact same process that goes into the hedge fund space. You've got same tools as I said before, but maybe one extra in the hedge fund when you can go short. But very much we put that investment process and the people around those two mandates, we actually merge them to ensure they've got the same thinking and processes and hopefully the performances turn out similar over time.
So the capital preservation still coming through. It's still
Sure.
key factor. Warren?
Yeah,
you
very
guys?
much similar. I mean, key capital preservation and avoiding permanent capital loss. I think if you look how we've run the flexible fund over time, we've always had a healthy weighting to cash, so roughly 20% in cash. And I think you never know when there's going to be a large drawdown in markets. And I think when you look at the fund's history, we've been quite opportunistic to take that cash and buy into the market. So you kind of have lower drawdown when the market falls, and then you participate on the upside by putting that cash to work. And generally, the fund's performance has then, if you look at it, it's kind of kept pace with the market during good times, and then your outperformance comes in during those periods of market weakness. If you add those two together, you'll outperform over time.
Great. And then the next slide I'm putting up here, and this is essentially just looking at the fund sizes of different funds and categories. And this is up until the end of July. So if one looks at, all the way to your left, where size sitting, the largest high equity fund in terms of fund size is 177 billion. If you look at the category where these three funds sit in, the CISA SA multi-asset flexible category, that category is 2.6 times smaller than that one high equity balanced fund. If you look at the 5 largest flexible funds as an example, they are 4.4 times smaller than that one high equity balanced fund. And then if you're looking at the individual funds, so Truffle, the biggest fund here at about 10 billion, that's still 17.5 times smaller than your largest high equity balanced fund. Battalier almost 25 times smaller, and then 361 is currently sitting with about 4 billion in fund size in that particular fund, almost just over 44 times smaller than the biggest high equity balanced fund. Now, this isn't to say that we don't like high equity or the big high equity balanced funds as an example, or from these larger asset managers. We do like them. We think that a lot of them have got great capabilities across the different asset classes. But in our INN8 Invest solutions, we actually blend those larger managers with some of these smaller managers in the solutions. So I think that this is also, quite an important question, and I want all three of you to respond. Is that when it comes to your size, especially compared to some of the more larger, more popular high equity balanced funds out there, how does your size benefit you in terms of your flexibility and that nimbleness? And I want you to provide me with an example. So Ian, let's start with you.
Yeah. No, I think size matters. Anyone who says it doesn't, the reality is it does. And I think, you'll see the correlations between as funds grow and get really big, how your returns start to move towards benchmark. And I think, at the end of the day, what does it mean? When you get too big, your ability to take advantage of volatility and opportunity goes down. It's just harder to move, and it's harder to get liquidity. And I think, take the SA market right now where liquidity is even moving lower. It's very hard if you're a big fund. It's very, very hard if you're a big fund. And I think that's why being small and nimble is certainly a benefit. And if I think back just a couple of examples, when the AT1 bonds were first issued in SA, these things came to market about, I think, 600 basis points over JIBAR. Their numbers were massive. So we sort of saw this and thought, geez, this is basically money for jam. And we bought masses and masses of, we took half the issue of lots of these placements. And eventually the market cottoned on and those margins started to tighten. But you can build a substantial position in your fund, which a big fund cannot get. So maybe they get a 0.2, whereas we can get 4%. We can get 5% of funds. Old Mutual, there was a sterling bond at one point that was trading yields in excess of 10% in London. We bought big positions, 5-6% of the fund, and I think we made an annualized 22% return in pounds when they eventually bought the bond back from us at 3%. So I think, being small and nimble helps you build positions which translate into better performance over time, or to be able to get more of those good ideas, whereas the big guys will struggle to do that. And I think that's probably the first thing. And then the second thing is if you have to change. So, as Si said earlier, it's one thing to buy attractively priced small caps, but if you get them wrong, you're going to own them for a decade. You won't sell those things. So, like a big fund, if you've built a big position in a stock and it goes wrong on you, you're going to wear that all the way down. Whereas for a smaller fund manager, we can say, listen, we've made a mistake. Guys, we are exiting this, and we put the capital to work somewhere else.
Yeah, and that's a great point. Thanks, Ian. Warren, just anything you would like to add to that?
No, it's very similar. It's a distinct advantage having the size. When you look at that slide, the category size and how big the funds are relative to what they've delivered, the category is way too small. It's underrepresented. Flexible funds should be a lot bigger. That's the first point. But the main thing is we can play in parts of the market, and especially in SA, where many other funds can't, much more wider opportunity set. I'll give you a recent example. A business like AECI, it was a 10 billion rand market cap company. It only trades 20 to 25 million rand worth a day. So a bigger fund simply can't build a position in that company. And that business is up 25% this year. It still trades on a 7 PE, new management team restructuring it. So it's like finding those type of opportunities that you wouldn't be able to find if you were a bigger fund.
Yeah. And maybe
So I've got a great example actually. So you looked at our stats there, and we say 1/44 of the size when it comes to a big flexible fund. So you can imagine if you've got a stock to sell, and we manage to just get out of that stock in a day, well then it's going to take 44 days for a big fund to get out of it. So we had this exact experience a few months ago. We were left with a smidgen of transaction capital on the day on the night before the warning came out from management the first time that there was going to be a total miss. I myself was actually my responsibility because I thought I was quite close to management, but obviously got slightly misled. And the next morning gave the dealer instruction, just bail us whatever price. Our entire lot across all our funds, not only our flexible fund, our hedge funds, were dealt in the 17s, between 17 and 18 bucks. Day one done. We now not even probably, or maybe are now, obviously 44 days past the trading update, but it's $5. So I can promise you that any larger institution was out at maximum 10 and probably still wearing. And they're actually lucky to one of the bigger institutions because they actually took us out in the 70s.
Yeah,
That's
a great example, Si.
Yeah.
Thank you. So the next slide that I'm putting up here is just the current asset allocation of all three of these flexible funds. And Warren, I'm going to start with you. You guys are currently sitting with the highest total equity exposure in your portfolio. So obviously your SA equity plus your offshore equity exposure. And this is mainly driven by your higher offshore equity allocation. I think even that your offshore equity allocation is the highest it's been in the fund since the inception of the fund. Just quickly, why are you so bullish on global equities? And maybe just also, if you look at from a sector point of view, your highest offshore equity exposure is to global tech. And you've got some of the so-called Magnificent Seven in there, which has done pretty well. And you maybe just quickly, what do you expect from these stocks going forward?
Okay, so I think when you look at our total equity exposure of 74, 75% on the slides there, our SA equity exposure is near the lowest it's been since the inception of the fund. So what we have been doing is there's one bucket, I guess, is where we're finding better opportunities offshore where we can replace SA listed opportunities. So for instance, we own Heineken in our offshore holdings relative to AB InBev, which is listed in South Africa. We own Philip Morris relative to a British American Tobacco. So we supplementing what would have normally been SA exposure with which we think is better opportunities offshore. And then you can look at the overall markets. Yes, PE multiples are high, especially in the US. I think but then you've got to take a step back and subtract like you said, the Magnificent Seven. The equal weighted S&Ps looks largely in line with its long-term history. And we don't own in our offshore tech exposure any Tesla, any Apple, or any Nvidia. Now, where we do have exposure, as you mentioned, is Microsoft, Alphabet, and Amazon, with Amazon actually recently being upweight and our biggest single stock position in that offshore exposure. So we looked at the AI opportunity. It came around very rapidly. If you looked in December, AI wasn't even mentioned. So you had ChatGPT launching, you had the NVIDIA results where they had the biggest beat relative to expectations in, I think, any listed company I've seen, and that shares up 240% year to date. But away from that, you get the three cloud providers, Microsoft, Amazon, and Google, where we position. Now, our view is that the most direct beneficiary of AI utilization in these large language models is going to be the cloud providers. All those models are going to be running on the cloud. They need large compute and they need large storage, which the large cloud providers are only able to provide. And generally, the large language models are only available on cloud. So that's where you can actually, as a business, take advantage of them. So we think the cloud providers are going to start seeing accelerating revenue. And you're looking at their valuations, they're reasonable. Remember the context that in 2022, there's a significant drawdown in tech. So we didn't own much. So Amazon was down 50% in 2022, Alphabet down 28%, and I think Microsoft 30%. So we opportunistically increased our exposures into that, and kind of we haven't sold any into this recent rally, and we're pretty comfortable with the valuations.
Great. So just in the interest of time, I still have quite a number of questions that I want to ask, but I'm going to cut that down a little bit. So, Sai, I've got a question for you. You guys are sitting with close to 50% in cash and bonds at the moment. If I'm not mistaken, the last time you guys had that much cash and bonds in the portfolio was March 2020. Just maybe give us a quick overview of why you are currently more conservatively positioned.
Yeah, I think first of all, we're not bullish. So you said marry your top-down view with your bottom-up view. Rates have not come down yet. In fact, inflation's been more stubborn around the world than we'd thought. And I don't think rates are coming down this year. And I think what's happened, you've got the savings element post-COVID that's running out at a fast pace in the US, and valuations are high. Even in the Magnificent Seven, which was mentioned, there's not much growth. In fact, some of those companies are actually going backwards, but the valuations are still going up. So I think we've been very nervous of overall global markets. We've been probably a little bit wrong year to date because they've done a bit better than we would have anticipated. But we're holding the line and thinking that the better opportunities are in the more fixed income space where you're getting double digits. In some cases, you're getting double digits in US dollars in some of the corporate space, bonds, corporate bonds. So we think for now that's the holding pattern. We've also, like many of the funds here, done a lot better when markets have come off. So we've done reasonably okay this year, still beating our benchmarks across all the funds. But think that for now, we need to just be more conservatively positioned and just wait for a pullback, which hasn't come, but hopefully will come. And there was a small one, caught it last month.
Yeah.
But
Then, Ian, just one question, or the last question for you, just in the interest of time. So at Truffle, you guys have quite a strong fixed income capability, and that's headed up by Hannes van der Westhuizen. And I think over the past couple of years, you guys have won numerous awards for that Income Plus fund, if I'm not mistaken. My question to you, and you alluded to this earlier about the AT1 exposure. You're currently sitting with about 6% AT1s in the portfolio at the moment. What would you say to clients who might question or be skeptical about that exposure, especially after what happened to Credit Suisse's AT1 holders in the UBS deal?
Yeah. So I think, the SA banking market is very well regulated. We've got foreign exchange control, so you sort of have a good sense of what the assets of our banks look like. So, the probability of finding that one of them has gone rogue and done something in North Korea is very low. And, the capital stack of all our banks is pretty high. So if you look at the amount of money that banks are holding against on a risk-weighted basis against those assets, they're all well capitalized. And the amount of return that one can get with very limited duration is very attractive. And I think, we've done well to be exposed to that into a period where spreads have compressed. but also in an environment where rates in SA are probably going to have to stay higher for longer. Notwithstanding maybe a peak in global rates coming in the next year or so, I mean, who knows? But I'm not sure we'll be able to cut rates to the extent that perhaps some of the other economies can. And I think then there's a benefit that one gets in the front end of the yield curve, where you're going to get a nice carry. And I mean, we would echo what Sai said in terms of the focus on yield. So if you look at our fund, I mean, the same principle right now is we're focusing on shares which have got very high dividend yields, where a big chunk of your return almost comes up front. Some of the banks and ABSA and Ned Group, dividend yields close to sort of 9 on a forward basis, and they're going to grow. There's going to be a little bit of growth. So you've almost got a free kicker on the equity, and then some very attractive, let's say, fixed income assets, all the way out, I'd say, to the belly of the yield curve. Perhaps not further than that. We're a little bit cautious, I guess, taking long duration. And I think the beauty is right now is you being paid to buy those assets, because you don't have to take a bet on getting a capital return. A lot of your return is coming up front in the cash flows. And that's because SA assets and some of these assets and some of the global assets that you refer to, like a Philip Morris on a 5 dividend yield and British American Tobacco on a 9, I mean, those are great returns just with a dividend, and then you're still going to grow. Yeah. So I think that sort of focus is important in a market which we think is expensive. And I think any number of things could set this thing off. And I mean, who knows, is it a liquidity event? I mean, the banking crisis in the US, I'm telling you, hasn't gone away. I mean, they are still losing deposits, those regional banks. They're drawing on funds from the Fed. And there's some big rollovers that are coming next year in the commercial real estate and in the corporate bond market. And valuations are pretty much, very expensive in the US. And everyone is all in, particularly in that group of companies, which I think, very concentrated. So that's a space we're staying away from and focusing on those high free cash flow yields, the dividends, the fixed income piece, which we think, first of all, will mitigate downside risk to our clients. Probability of losing money will be low. And then secondly, you almost know what a portion of your return looks like over the next rolling 12 months. And then there's a little bit of an equity kicker in that if things look a little bit better.
Great. Thanks, Ian. So thanks, guys. That brings us to the end of our panel discussion. So today you've heard about the flexibility of these strategies, and you heard from the panelists how their size allows them to be nimble and be able to move in and out of positions quite quickly. And we think that these characteristics, especially that flexibility and nimbleness, is quite important, especially given how quickly the investment landscape can change. And that's essentially why we use all 3 of these flexible funds across our different INN8 Invest solutions. A big thank you once again to my panelists for joining me today. And of course, a big thank you to you, the advisors, for taking the time to come and listen to us today. Thank you very much.
INN8 is a registered trademark of Stanlib Wealth Management Pty Limited, an authorized financial services provider.